So the S&P 500 is already in a bearish downtrend right now. And the big short investor who predicted the 2008 crash is saying that this could be even worse. Let's watch this video together and learn why.
2008 coming, and now he's sounding the alarm again. Michael Burry says AI stocks are a massive bubble that's about to pop, and he's putting his money where his mouth is. So if you've been concerned about the AI industry being a bubble with the countless billions of dollars being poured in, I'm going to break it all down, but make sure you stick with me until the end, because at the end of this video, I'm going to show you what the needle has to be to actually pop this bubble. Michael Burry rose to fame because he correctly predicted the 2008 housing market crash. But not only did he predict that the housing market was going to crash in 2008, he put his money where his mouth was, because he shorted the housing market when everybody said housing prices cannot go down. And
Okay. He also has made a call every month since then about how, it's either going to go to the moon or go to zero. I'm sure that there were accounts dedicated to the sole purpose of listening to what Michael Burry was saying. When you go somewhere and you publicly declare, well, the stock market's going to go to 1 million or the stock market's going to crash to zero, right? Those big predictions can gain traction. And if you happen to be right, if you call it once a month, every month, and you happen to get it right once, you can hang your hat on that forever. That's exactly what Michael Burry just did. And in fact, Michael Burry, the guy we're talking about right here, just closed down his own investment fund. And you don't normally close down an investment fund because you've made so much money. It's usually the opposite. But what do I know?
And he continued to hold a short position even though people said he was crazy, and then he made a fortune when the housing market ultimately burst. And now Michael Burry is firing off warnings again, this time about AI stocks. He started by posting this tweet: "Sometimes we see bubbles. Sometimes there's something to do about it. Sometimes the only winning move is not to play." Then just a few days later,
Hang on. I agree with that, actually. All stocks are bad and sometimes they act right. Right? So we see bubbles. Why not ride the trend up on the bubbles? Sometimes there's something to do about it. Right, exactly. Ride the trend up. Ride your stage 2 uptrends. What's a stage 2 uptrend? What in the wide world of sports is a stage 2 uptrend, Chris? Oh, I'm glad you asked. You've probably never heard this before. But the market moves like this, right? This is your stage 1 sideways trend, your consolidation, your stage 2 uptrend. That's the one that everybody wants to be on. Stage 3 is your topping pattern where the moving averages are crossing over. Stage 4 is the big, nasty, scary decline. This is what it looks like, okay? And this is not a theory. This is reality. I can show you Tesla, which had this exact same thing happen earlier this year. Okay. There you go. There's your market cycle right there. That actually did happen, does happen. I can show you Cake, the Cheesecake Factory, which is in the middle of a stage 4 decline right now. Tell me that's not the market cycle. This is the reality of trading. People getting more and more greedy, and then people getting more and more fearful. All right. All of that is true. So going back to this, sometimes we see bubbles. Call it whatever you want. I would call it a big, beautiful uptrend. You can ride that trend all the way up. Sometimes there's something to do about it. Yeah, like buying the mess out of it on the left side as buying stocks as they're crashing up. Sometimes the only winning move is not to play. I agree with that too. If you don't have a plan that is working at the moment, or you don't have stocks that fit your plan, the best thing to do is what I like to call sit in cash and don't F up your portfolio. Sit in cash and don't F up your portfolio, because you don't want your account to look like the market cycle, do you? No, of course not. You want your account to look like this, where you catch every stage 2 you can, you go sideways, you catch another stage 2, you go sideways, you catch another stage 2, you go sideways. You don't want every time the stage 2s is over to give back any of it. Certainly not most of it, which a lot of people do, and that's what they call the boom and bust cycle. You don't want that. So that is why I say sit in cash and don't F up your portfolio. So there's some sound words to this, and of course you can read into it a million different ways, and it seems like a lot of people did.
To do about it. Sometimes the only winning move is not to play. Then just a few days later, Michael Burry revealed that he placed a $1 billion short, a $1 billion bet against Nvidia and Palantir, because he believes this bubble.
Ooh. He placed $1 billion short bet on 2 of the biggest flying stocks that there is. Right, and Nvidia is going to open up like 5% this morning. Palantir is also feeling it as well. Palantir is looking up as well, right? And here's the deal. If you want to go short, what you want to find is a bearish market, right? When the 10 is under the 20, price is under the 50 on the market, when the market's pushing down. You want to find a bearish sector where the whole sector is moving down, and then you want to find the weakest stocks in that sector. That's how you find successful shorts, and you do the opposite for successful long trades. I would not call going short against Palantir or going short against Nvidia the most sound things to do with my money, and certainly not with other people's money, and certainly not to the tune of $1 billion. That's a bold move, Cotton. Yeah, for sure. So if this were to play out, he could make tons of money, but he's already starting off on the wrong foot, right? When the trend is moving up against you, counter trend trading is a very, 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 very difficult trade to make. And he's smart enough to know better. So I don't know. Clearly he's smarter than me. So let's hear it.
Bubble is about to pop. By the way, when you short a stock, that means you're betting that it goes down, and you make money if that stock goes down, not if it goes up. And then right after that, Michael Burry followed it up by posting this tweet with 3 different charts explaining his investment decision. So what I want to do right now is break down these 3 charts one by one. In chart number 1, Michael Burry explains that we are seeing the same type of investment today in AI that we saw leading up to the dot-com bubble bursting. Take a look.
Which I think this is a great opportunity to show you another example of the market cycle. Let me switch this to monthly charts, and we're going to go to a stock. You probably heard of it, called Cisco, CSCO. If you go and look at the monthly charts of Cisco, it absolutely had the market cycle. Another example that the market cycle is real. It is not fiction. It is not theory. It is reality. Now you zoom out far enough, Cisco went from basically the year 2000 all the way to the year 2022 to get back to break even. If you bought Cisco right here because you were so excited, right? This is what happens to most people. They hear about it right near the top, right? The herd buys right near the top. And then the herd is terrified to sell and take the loss and move on. So they'll hold it, and they'll hold it for as long as it takes for them to get back to break even. And in this case, it took 22 years for Cisco to get back to break even. Okay. And again, he's talking about bubbles, right? Ride those bubbles on the way up. Buy stocks as they're crashing up, not as they're crashing down. Because also there were people on this side of the curve who were buying the dip, saying, oh, you know what? It's fine. It should go up from here, right? It's gone up this much before. It'll do it again. And how long did it take for them to get back to break even? Right? Let's go to the Bank of America, BAC. Bank of America is just now getting back to break even since the height around 2006, right before the great financial crisis. 2006 to nearly 2026, right? Let's just call it 20 years. There's Cisco, there's Bank of America. And that is why you don't buy on the way down, is because you don't know how far down it's going to go, and you don't know how long it's going to take as it's on the way down. Or look at this, you could buy it on the right-hand side of the curve. You could buy the stocks is crashing up, stocks are crashing up, and you can beat a profitability that much faster. Look, you could trade it here and get out, here and get out, here and get out. And then you'd still be better off. You would have made so much more money than the person who bought it here, like everybody does in the curve. And this is why normal people aren't successful in the markets, because they just repeat the same thing over and over and over. And then when it goes down, they can't admit that they're wrong. And then they have to hold the stock for 20 years to get back to break even.
This chart shows tech sector investment growth in green and technology, media, and telecom investment growth in the tan color. These gray bars show recessions, and what you can see is that he's pointing out that investment growth is reaching levels that we generally see right before a recession. In chart number 2, Michael Burry points out what's called a closed loop, which is that there's a few major AI players that are all feeding money to each other, which makes it seem like the AI profits are much larger than they actually are, because it's really the same money that's floating around from one company to the other. Take a look. This Bloomberg chart shows how a small group of AI companies, especially Nvidia and OpenAI, are powering and even...
So I have heard this, and you've heard it too. And this is a real weird circular thing that's going on. OpenAI says they're going to start working with AMD. And then AMD says, okay, cool, we'll buy from OpenAI. And there's nothing actually transacting. It's more like a promise between the two, something like that. Granted, I could be 100% wrong. OpenAI says they're going to work with Nvidia. Nvidia says they're going to invest in OpenAI, and both of them benefit. OpenAI says they're going to work with Oracle. Oracle says they're going to work with them, and they both benefit, right? there's very much a circular. I'm having trouble with that word today. A circular relationship going on out in the AI space right now. Absolutely.
Even profiting from a massive interconnected money loop in the AI industry. Essentially, the same money keeps circulating between a handful of companies, inflating valuations across the AI industry. And then in chart number 3, Michael Burry points out that we're starting to see slower growth in this AI industry. Take a look. In this chart, Michael Burry is trying to point out that cloud computing growth, which is the backbone of artificial intelligence, is starting to slow down because we're seeing Amazon, Alphabet, and Microsoft seeing a slowdown in growth in.
And this makes sense too, right? Imagine from 2018 to 2022, all of this was new. So the amount of growth had to be new, right? Think of it like the smartphone market. At one point in time, people were buying the mess out of smartphones, right? But there comes a point where there's market saturation, and then the growth of that is going to be very difficult because your market penetration is nearly ubiquitous. Big words of the day from Chris. My itty bitty baby brain's cooking. I can't say circular, but I can talk about this stuff. And then eventually, you've got the entire total addressable market filled with smartphones, and so therefore there's no more growth to be had. You're basically just replacing smartphones at that point because everybody who's going to get a smartphone already has one. Same thing could be happening in the AI space.
Cloud computing. This is why Michael Burry says that AI stocks are a bubble, and this is why he's justifying his billion-dollar short position against Nvidia and Palantir. Now, there's a couple
NBA bros unite. I love it, Cameron. He literally learned this in his MBA this year. Outstanding.
things that I want you to know. Number one, we don't know when that will be because Michael Burry just delisted his hedge fund, so he is no longer required to disclose his short positions. Let me read you the letter he wrote. Dear investors, with a heavy heart, I will liquidate the fund and return capital. My estimation of value in securities is not now, and has not been for some time, in sync with the markets.
Huh. Interesting. Bro just shut down his investment fund at the same point where I'm opening up more investment funds, and has not for some time been in sync with the markets. If you want to know how to be in sync with the markets, Mr. Michael Burry, I hope he watches this. That'd be so sick. So you put 3 moving averages on your charts: the 10 EMA, the 20 EMA, and the 50 EMA. And listen, I know I'm a broken record. I know you've heard me say this before. And I know the YouTube commenters are saying, oh, I've heard this guy say this over and over and over again. Good. You know why? Because it works. You know why I say the same thing over again? Because it never fails, because it's math, right? When your 10 EMA, your short term, is greater than your 20 EMA, your intermediate term, and price is greater than your 50 EMA, your longer term, and all 3 are in sync together, that is a bullish trend. Now, there are times, like right here, where it starts a bearish trend and then it reverses, but every big, beautiful trend, either up or down, starts exactly the same way. You might make a buck or lose a buck in the process, but if you are on the right side of the curve, you can make so many bucks as it runs and doesn't reverse, right?
With heartfelt thanks, but also with apologies, I wish you well in your future investments.
I wish you well too, my friend. I wish you would learn the outlier trend template like we talk about.
The second thing is a lot of the references to the AI stock bubble is made comparing it to the dot-com bubble. So let's go a little bit deeper, comparing AI stocks to dot-com stocks before the dot-com bubble burst. So this is where I want you to start thinking like an investor, because when the dot-com bubble burst, it did not mean the internet companies went away. It meant that the bad internet companies went away. It meant the funding dried up and that the good internet companies saw their valuations fall. And then they were able to skyrocket after that because they had less bad competition. So it didn't mean that internet companies went away, but it did create an investment opportunity for the financially savvy who understood how to find opportunities that most people were overlooking, because the reality is market crashes and recessions create more millionaires than any other time, because when you have these downturns.
Hold on. The crash itself doesn't create the millionaires. You're not making money on the way down. That is an impossibility. It is a 100% statistical impossibility to be making millionaire, jillionaire, Brazilianaire money on the way down until it's on the way up, assuming you're buying the stock and not shorting the stock. And that's what he's talking about here. Okay. A lot of people love to spout that. Millionaires are made in the crashes. They're not made on the crashing part. They're made on the way back up. That's why you need the trend template in place. Ralph Rafal had a great question. So why not go long today on Nvidia if you say it will pop up heavily? First off, I'm not saying it's going to pop up heavily. I'm just looking at what I see on the pre-market right here, up 5% or so. by all means, my friend, if that's what your plan is, to FOMO into it. And I know we talked about this just a couple of minutes ago. I don't want you FOMOing into anything, because FOMOing into things is what's going to catch you in a situation like this. It's exactly that. It is exactly this euphoria thrill type of situation right here, right? If it fits your plan, by all means, go for it. I don't care. But Nvidia, as of yesterday, has a 10 under 20, price under 50, a bearish trend. And like I said, trends do reverse, right? But it can do something just like this and come back down. The market is weak. Nvidia, as of yesterday, was weak, and we'll see what happens today. And let's see if it holds, right? This big move up this morning, this how much is this going to be? This about 5% move up this morning is no different than this 11% move just a couple days ago. Okay. But when the market is weak, every stock, in fact, let's pop into OVTLYR and let's talk about Nvidia real quick. I'm here for you, dude. I mean, like I say, if this is part of your plan, by all means, go for it. Go for it. It's not part of my plan though. All right, let's pop into Nvidia and let's take a look. So using the OVTLYR 9 template over here, the market is 40% of any stocks move, including Nvidia. The trend of the market is down. The market has a sell signal. Market breadth is weak as well. Let's pop over to market breadth. Market breadth is where all of the stocks are getting more and more buy signals and less sell signals. That's not what we see today. What we see today is even more stocks with sell signals. We're down at 22% of the market having buy signals. The rest of the market, the other 78%, has a sell signal. So market breadth is weak. We see less and less uptrends, more and more downtrends. Okay, so that's 40% of the move of any stock. 30% of the move is through the sector. The fear and greed in the tech sector is getting more and more fearful. The breadth in the sector is getting more and more selling, worse and worse, right? Less uptrends, more downtrends. So 70% of the move of that stock is not working against you. Lastly, the trend, it's in a bearish trend, has a sell signal in place, and the fear and greed is getting more and more fearful on Nvidia. Now, the only reason that this is lit up is that there's not an outlier block right on top of the price right here. So honestly, it actually does have a little bullish order block right there too, in fact. So this is a 1 of 9. So for me, I'm not trading a 1 of 9. But here's the deal. I want you to always remember this. You come up with your own plan and you follow that plan. But if you're going to FOMO into something and then panic sell out of it, I don't think it's much of a plan. I don't think that's a long-term viable strategy. But dude, listen, if it works for you, go for it. And you're never going to hear me say, you must do this thing that way or another. Now, I'm always going to give you personal authority, personal agency to make your own plans because I want you to be successful. And Chris is never going to tell you to sell your SoFi shares.
The people that have cash and the people that are financially savvy can come in and buy great investments at a discounted price. That's the way that I want you to think as an investor. Instead of panicking about bubbles, find the opportunity through bubbles. So let's compare the dot-com bubble and the AI potential bubble. That way you can understand some of the similarities and the differences. And for those of you that are investors or want to become investors, a reminder that I have a brand new free investing masterclass where I walk you through how you can get started.
Wait a minute. Did somebody say OVTLYR University? If he's going to pitch, I'm going to pitch. Let's go. Did somebody say OVTLYR University?
Are you ready? Ready? Let's go! Respect is earned. Respect is never given.
That's right. SoFi, not SoFi. I saw somebody write SoFi in the comments. OVTLYR University happens every Tuesday and Thursday, including today, where I'm going to be teaching you with no strings attached, with no extra cost. Everything is 100% free. Everything that I've learned in 16 years of trading. Now, if you are an outlier, it will be available to you as a live stream. If you are not an outlier just yet, it's only 82 cents a day, but you'll be able to see the replay on YouTube forever. Okay. I'm trying to give you everything you need possible to be successful. Okay. Everything. This week, we're covering trading psychology. And next week, we might start working on what trends and everything look like, which if you've been watching this channel for a while, you know exactly where I'm going here, but I want to teach you everything that you could possibly need to know. Now, listen, 50% of the time, 50% of the people are going to listen. It's going to go through one ear and out the other. 25% of the people that are going to listen half-heartedly, they're going to implement a plan. They're going to fail, and they're going to come back and say, Chris made me sell my SoFi shares. And then 25% of the people are going to listen. They're going to implement it, and they're going to create generational wealth, and it costs absolutely nothing. And it will be available on YouTube forever. And people charge $12,000 a quarter for even for less than what we're going to give away 100% for free to help you out, because I want you to be successful. Let's keep going.
Dot-com bubble bursting was an influx of investment into dot-com companies. In 1995, it was about $3 billion worth of VC funding going into dot-com companies. By 2020, it was $100 billion of investment dollars going into dot-com companies, which was an increase of 35 times over just the course of 5 years. We can compare that to the AI industry, where corporate AI investment
That's more than 5 years. He said 1995 to 2020.
grew from $103 billion in 2019 to about $252 billion in 2024, which is an increase of around 2.5 times over those 5 years. During the peak of the dot-com bubble, we saw the PE ratio average for NASDAQ companies at 120 times, which means that on average, the NASDAQ, which is a group primarily made up of tech companies, was selling for 120 times earnings. So if you made $1,000 of profit as an internet company, your company would be valued at $120,000, 120 times earnings. But the ultimate
That's crazy.
really meant is he had a lot of companies that had no revenue and no path towards revenue, that had these sky-high multi-million-dollar valuations, which created this very high PE multiple. Today, the NASDAQ, which is still primarily comprised of tech companies, which are now primarily AI, has a PE ratio average of about 35 times earnings, which is a lot lower than where we were leading up to the dot-com bubble, but it's still higher than the average, because the average historical NASDAQ PE ratio is 20 times earnings. And then we can look at oversaturation of value in tech companies, because during the dot-com bubble bursting, we saw that tech made up a third of the S&P 500. The S&P 500 is a group of the 500 largest.
Okay, I want to point this out. I'm sure he's going to get there. I'm going to pull up the S&P 500 map. Now, this is 1 day. It needs like 15 minutes to update. Let's go to 1 week. So this is going to look really ugly. Over the last week, there is blood red nearly everywhere in the streets right now. Visualize this, right? The S&P 500 is made up of roughly 500 stocks. I know one time I said, this is how funny YouTube commenters are. One time I said the S&P 500 is made up of 500 stocks, and somebody came in the comments and they're like, actually, it's made up of 512 stocks. You're completely wrong. You look so stupid on the internet with your stupid glasses. It's 512 stocks. How do you even sleep at night being so stupid? Shut up. Shut up. It's roughly 500 stocks. The biggest ones in this chart right here are the ones that have the biggest swing in the market, right? This is the big banana charts around here, okay? So if Nvidia has a big move up, it's going to have a much bigger swing than the entire industrial aerospace industry over here. The entire industrial aerospace industry over here means nothing compared to what Nvidia is. So these big stocks drive the market. So let's see if he talks about the concentration of that real quick.
Largest companies in the stock market. And at the peak of the dot-com bubble, we saw that.
Yes, I heard him. He was a douche, and I heard him just like that.
Tech companies made up a third of the S&P 500 valuation. In fact, one company, Cisco, made up 4% of the total S&P 500 valuation. Today, the Magnificent Seven, which is a group of the 7 largest tech companies, including Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla, those 7 companies alone make up 34% of the S&P 500.
Okay, so again, hey, it's a 100% backed by physical civil. What was that again? PSLV, sponsored by PSLV. Yeah, so what he's saying here is that 34% of the market is concentrated in these 7 big stocks right here. That concentration is real, right? That concentration can be scary, can be brutal. If one of these guys falls, it's going to take the whole market down with it.
So we have much more saturation of value into a few companies than we had before. And Nvidia by itself makes up more than 7% of the value of the S&P 500, which again shows more concentration today than we had before. Here are the similarities. We are seeing a big influx of investment dollars into AI stocks, just like we saw with dot-com companies. We're also seeing higher than average PE ratios with AI stocks, just like we saw with dot-com companies, although the PE ratios that we're seeing today at 35 times is significantly lower than what we saw at the peak of the dot-com bubble at 120 times. But we're also also seeing that saturation of a lot of value into a select few tech companies, which is much more severe today than we saw during the dot-com bubble. Now that we understand some of the similarities, let's take a look at some of the differences, because you're going to see now how the needle is going to be very different. The needle that popped the dot-com bubble was tighter money supply, because the Federal Reserve Bank raised interest rates 6 times as a way to cool down the economy as these dot-com companies.
Okay, I had this once. I don't know if I still have it. Yes, I do. Sweet. Okay, so I can plot if I do it correctly, which I may not have done it correctly. Daggum, how do I do it correctly? I have the Federal Reserve on here. Someone tell me in the chat what I'm doing wrong. I don't know why it's not showing. Style, visibility, style, price line. No, daggum. Line, close, price line, default tick. I don't know. I want it to be on here. I want to show the Fed funds rate in addition to the price. Why am I not seeing it? Okay. I had it there before. I don't know why it's not working. Anyways, it's really interesting when you can plot them side by side, which I can't do right now. Thank goodness this is a live video. Awesome.
Were blowing up, and as money became more tight and more expensive to borrow, the investment institution said, now because it's so much more expensive to borrow money, we can't keep blindly throwing our money into these dot-com companies hoping that they're going to make a profit, so we need to find dot-com companies that are actually making money.
Oh, hang on. Lawrence has a great point. Numbers probably too low. What if it might be a scaling issue? Hang on. This, and then if I come over to the right hand side, merge all on the right. I don't know if this. Wait a minute. Did it work? Did it work? No. Add EFR again and select a new price scale when adding. Okay, VacLab is a genius, so I know that this is going to work. Okay. Oh, there it is. Okay, do that. New price scale. Look at that. I told you. Everybody say VacLab in the chat. VacLab in the chat. Because dude is a genius. Within like 4 seconds, he knew exactly what to do. Okay, cool. So the big blue line right there is the federal funds rate. Okay, the Fed funds rate. So you can see right here, as the Fed funds rate was increasing, Nvidia's price was also increasing. Let's go to the SPY. I'm so glad that we figured this out. Thank you very much. As the Fed funds rate was increasing, the SPY was also increasing. There is not a perfect one-for-one relationship here. A lot of people want to come in and say, when the Fed raises rates, it kills the stock market. Or when the Fed lowers rates, the market always goes up. That is just baloney. That is hot baloney sausage. Is there a correlation? Probably. I don't know what the number of the correlation is right now. But the Fed is lowering rates, the market goes up. The Fed is raising rates, the market goes up. The market and the Fed are not 100% connected. Okay, cool. Thanks, VacLab. I really appreciate you. And also, don't forget to hit the like button. Great point.
And when that happened, the money started to dry up. Investment dollars stopped going in, and the dot-com bubble burst, which caused the major dot-com bubble crash that happened between 2000 and 2002. Today, it's very different, because we're not seeing a tightening of money supply. We are seeing a loosening of money supply. Today, the Federal Reserve Bank is not raising interest rates, they're actually lowering interest rates as a way to spur.
Again, they are lowering rates. This is facts. But that has, I would not personally say that that is the reason why the market's going up. Because we can just drag this over and see, rates going up, markets going up.
Spending into AI investing to make the bubble even bigger. And to encourage banks to lend more money, the Federal Reserve Bank is also ending quantitative tightening come December 1 as a way to make money more accessible. This is why I say the needle is different. We always have a bubble. We always have a recession coming. These things are common denominators in our economy at all time. There's always a bubble, there's always a recession coming, because they are a part of our economic system, period. But what popped this was tightening of money, raising of interest rates, which made it more expensive for investors to keep investing money into dot-com companies. So they had to become more picky with their investments, which meant the money stopped going in and valuations started going down. Today, we're seeing high valuations, we're seeing concerns about a bubble, but the Federal Reserve Bank is not tightening money. In fact, they are making it easier to access more money. They're cutting interest rates, and they're also ending quantitative tightening to add more money into the economy, to make it cheaper to borrow money, and to encourage banks to continue lending, which generally makes bubbles even bigger. So the question then on every investor's mind is, if the needle is not tighter money, what could potentially be the needle? Well, take a look. Here are 3 possibilities that you want to keep your eye on. Possibility number 1 is the job market. The artificial intelligence industry is replacing a lot of human jobs. So although the industry is booming, although the adoption is booming, although company profits are growing because of AI, there's less and less human need. Now, that doesn't mean there's not going to be a need for humans, but what that means is the adoption rate for human jobs with AI is growing slower than the reduction of human jobs. Or in plain English, today AI is taking jobs faster than it's creating jobs. And so if people are losing jobs, that means that people are not going to have incomes to continue supporting the economy or buying food for themselves. That could potentially be a needle, because if we're producing products but people don't have money to buy those products, that's a problem. Number 2 is extremely high investor expectations. People
Don't set expectations, folks. This is a real core component of why you can be a successful outlier, is not setting an expectation on the trade. Let me see for the slide for this real quick. There are no expectations on the outcome of any one individual trade. Now, why do we say that? Because first off, we don't know where the market's going to go. Absolutely an impossibility of knowing where the market's going to go. And even Jaspreet over here talking about how the bubble's going to pop. Even Michael Burry, who this whole video is about, Michael Burry was saying he's out of sync with the markets forever. Nobody knows which way the market's going to go. So you shouldn't set any sort of expectations, right? You shouldn't set a profit target, because there's like there is a chance that it hits your profit target, but the market gives no monkey donkeys whatsoever about what your profit target is at all, right? However, like he's saying right here, a lot of people have the expectations that things will grow permanently forever. There was a comment I just saw a minute ago. Where was it? It's from Steve Mucha. Luckily, every time I go against the outlier plan and his own plan, that's the point here, he loses money. Now, he'll always follow the plan. Will I sometimes lose? Yes. But that's part of my plan and part of the statistics included, right? That's why we've spent so much time building the buy and sell signals. And then we went through and created 4 different plans that work throughout the year at different times. And there's no more trust me bros around here, right? Plan M has an expectancy of 2.25% on every trade with a 57% win rate. Plan A has an expectancy of, let me find the slide here, of 1.22% with a win rate of 46%. Okay, both of those are great, but Plan M is clearly better. And then Plan ETF over time shows a 1,140% return over the last 5 years, right? This is what it looks like when you have a plan in place. Now, the real key here is that in order to get these returns, it had a systematic rule set to follow for entries and for exits. Now, most people can't follow a systematic approach with entries and exits because they want to FOMO into things, right? They want to say, oh, I know this stock is going to go up. Oh, Nvidia's popping up this morning. I should buy some of it. Oh, this, oh, that. When you have a plan that has a statistical outcome, you have to follow it to a T to achieve the statistical outcome results, right? It's just like flipping a coin. If you flip a coin 5 times, it might land on heads all 5 times. Does that mean that your coin flip is actually a 100% chance of landing on heads? No, of course not. But the more times you trade, the closer you will get to your expectancy. So we want to have as many trades as possible that fit our setups when they come in order to achieve that outcome. So Steve, I really appreciate you taking the time to do that. And that's something we do different than most people on YouTube, is that we don't set expectations. We don't do profit targets. We just follow the data.
People who are investing the money into AI stocks are expecting companies to produce big gains, big profits, and huge returns. This has been the ongoing trend for the last number of years, and this is now getting to the point where if companies slightly miss expectations, it can cause a big downturn in the stock itself. And so if we start to see more companies that are not hitting the same growth that they were seeing in the past, that could cause valuations to fall because people start to realize that we're not going to see the same growth that we were expecting previously. And potential needle number 3.
And again, that goes back to the charts we saw earlier, right? The expectation of infinite growth forever is a flawed assumption, but a lot of people have that, right? It's like, hey, Amazon went up 4% this quarter in year-over-year sales, and if they don't go up 4.2% next quarter, then I'm gonna sell my shares. Really? What if it's 1.2%? It's still growth, but it's not It's not exponential growth always and forever. Yeah, people are crazy. People are fearful and greedy all the time. You need to have a plan.
Is value exhaustion. Goldman Sachs, which is one of the leading investment bankers on Wall Street, says that we've seen so much AI investment chasing high valuations. If it slows down, the whole market can come down. Take a read. Goldman Sachs says the AI trade is going full throttle, a positive energy that is driving up the broader stock market, but it will slow down.
Facts.
At the end of the day, any asset, whether it's an AI stock, whether it's gold, whether it's a house, whether it's this marker, it's worth what somebody else is willing to pay for it. If you think and everybody else believes...
Hold on. He's describing the greater fool theory right here. I'm actually excited about this. And then I'll jump in after that.
This marker, whether it's an AI stock, whether it's gold, whether it's a house, whether it's this marker, it's worth what somebody else is willing to pay for it. If you think and everybody else believes that this marker is worth $1 and I cannot sell it for $1, I can think it's worth $1,000 all day and night long, but if no one's willing to pay me more than $1 for it, it's only worth $1.
Boom. That is what a market is, right? You can take any asset, any consumable, and you can say, if I cannot find a buyer for this, then I have to lower my price until the point where a buyer is like, okay, you know what? That's a fair price. I'll be willing to take it. So what he's describing right there is the market cycle, right? What he's describing right there is exactly why the market cycle looks the way that it does, is because people on this side, they're buying it today. Other investors are looking at it saying, man, I sure would love to have it. And they're like, well, okay, sure, I'll sell it to you, right? So investor one sells it to investor two at a higher price, and then all the way up, right? Now, when it gets to the top up here, this is, like I said, the greater fool theory. If I can buy the Nvidia stock today, hold on, let me use a prop. This is a good prop. If I can buy this Guinness coffee mug, which may or may not have Guinness in it, may or may not have coffee in it, I don't know. But if I can buy this Guinness coffee mug, I spent $40 on this, by the way. I was like, this was at Disney World a few weeks ago. I walked into, they have an Irish pub down. I'm a huge Irish pub guy, and I love Guinness too. I walked into this Irish pub, and they had this sitting on the shelf. They had two of them there, and they had $40 a piece on them. I'm like, I don't care what it costs. This is coming home with me. In that moment, I was the greatest fool. Was I a fool for spending $40 on this coffee mug? Absolutely, 100%. But let's say, for example, that Guinness is having a huge run. People are loving it. And people are like, man, I sure would like to have that mug. And I'm like, well, you can for $50. And so they're like, okay, cool, I'll buy it for me for $50. And then it turns around, and let's say that I sold it to Slipknot. Let's say that I sold to Slipknot. And Slipknot's like, I'm tired of doing rock music. I want to do Guinness mugs now. So Slipknot, he buys it from me, and then he sells it to William, the skinny buff guy. And then William is like, man, this is a great mug. I better spend $80 on it. I feel like that's pretty expensive. And then Senior Wahoo comes along, and he's like, you know what? That's a great mug. I'll buy it from you for $100. And then nobody else comes along after that. Senior Wahoo, in this case, becomes the greatest fool. The greater fool theory is, I'm going to buy it today because there's going to be a greater fool somewhere down the line to buy it from me at a higher price later. This is what happened with NFTs. Remember the stupid monkey pictures, right? People were willing to pay whatever it costs because they thought they could buy it today and sell it for a higher price tomorrow. At some point in time, somebody bought it at the top, and they were the greatest fool. This will happen to you, and it has happened to me, and it will happen to both of us again in the future, because we will buy the top. We don't know where the top is. We just know when it's moving up. At that point, the price will start to come back down. So Senior Wahoo's like, frick, I got to offload this, right? So he's like, you know what, Kostya, I know that you want this mug, and can we make a deal, right? I mean, I bought it for 100. I don't want to sell it for 35. Will you take it from me for 60? And Kostya's like, fine, I'll pull it from 60, right? And then Clayton, he's like, Kostya's like, I gotta get rid of this thing. Kostya's over here. He's like, I gotta get rid of this thing. How fast can I get rid of this? And Clayton comes through, and he's like, you know what? I'll give you 35 for it. I'll give you 35 for it. And then the price comes down even further. So this same asset went all the way up because people were excited to buy it. It hit a peak, and then it came all the way back down because at one point in time, there were no more greater fools willing to buy it for higher prices. And he was definitely panicking. So that's what the cycle that he's talking about is right here. Now listen, I want to help you out in as much ways as possible, and the best way that you can help yourself out is by subscribing to this channel. And if you're looking to save time, make money, and start winning with less risk, click one of these 2 videos, and we'll talk soon.